Hey guys, welcome back to Dividend Obsession. My name is Troy. In today's video, I will be detailing how to start your dividend journey and some good places to start looking for your own individual dividend stock. Disclaimer, I am not a financial planner. Please do your own research for your own dividend stocks to add to your own portfolio. Now let's get to the content. Okay, so getting started investing can be a very daunting task, very scary, very intimidating. You're messing with real money at the end of the day, your own real money. So I completely understand, a lot of people are like, oh, I don't want to lose money in stocks. I don't want to invest. But I want to put a chart up for you guys so you guys can see just how important getting started young is. So consider the chart on your screen. What this chart will show is that Becky, we have two different people, just random people's names. Becky contributed $2,000 per year from age 21 to 31 that grew at 8% interest. Compounded yearly, and then she stopped investing at 31, but her $20,000 that she invested continued to grow at 8% year over year until she wanted to retire at 65. So again, this is $20,000 of her own money over 10 years. Person two, we're going to call him Bill. He waited until he was 31 years old to start investing, which is not old. 31 is not an old age, but he waited. He had other things to do in life. He didn't think he was old enough to start investing for retirement. And then 31, the day hit. He was like, hey, you know what? Let's consider investing for retirement. So he waited until then, and he invested from 31 years old to 65 years, which is 35 years. That's how long he invested. He added the same $2,000 per year, also earning the same 8% year over year in compounding interest, which totals $70,000 of his own money. And you think about it. Okay, so who would you think has more money at the end of this? So I mean, if you're cheating, you looked at the bottom of the chart first. So Bill put in 70,000, Becky put in 20,000. As you can see, despite Becky not contributing any of her own money after the age of 31 and Bill adding money for 35 years compared to Becky's 10 years, Becky ends with over $90,000 more by the time they both reach 65 years old. And I just wanted to use this chart. This would have been even more exaggerated if Becky, was investing in high quality dividend stocks, earning dividend payments, turning on the drip, having the dividends pay her more money. And if Becky continued to add money the whole time, this would have been not a fair fight. This, again, I'm not trying to show this chart to show, oh, it's too late if you're over, 31 years old. But I do want to show you that if you're watching this video and you're young, getting started now is your friend. You can't replace time and compounding interest and time together. It's the eighth wonder of the world, it's been called. So very, very important to get started. So I wanted to help you guys more or less figure out how to get started. And like I said, it is scary. So what I wanted to do is outline a very quick video. It's just 5 simple steps. And the first step is you have to make decisions on a couple of things. So you want to decide your time frame, how long you want to be investing, how long you want to work until, also known as when you want to retire. You also want to decide your risk tolerance. This is basically just, do you want to put your money in Dogecoin and, maybe make a lot of money, maybe probably not make a lot of money? Or would you rather put your money somewhere where it's maybe more passive, such as like an index fund, where it's like, hey, this is a basket of funds. Let me put my money in here. I'll just keep adding money to it. I won't look at it. And then, the day you decide to retire, you look at it, you're like, wow, I'm a millionaire. Or you could do individually managed dividend stocks, which is one of the paths that I've chose. Where, it's individual companies and you pick individual companies based on your criteria. And then you go from there. You add to the positions, you get dividends, you reinvest them, you get the whole 9 yards. So deciding your risk tolerance is very key. And then the next thing you want to do is decide the criteria you want your own individual companies to have if you do decide to go the individual route. And certain criteria can be like maybe investing in companies that have a really good name brand or brand recognition is important to you, such as like Apple or Nike or whatever, UPS, something like that, where you're like, hey, everybody knows Apple, Nike, UPS. All three of those do pay dividends. Maybe that's something that's important for you. Another thing you could do is you're like, hey, I want companies that's paid dividends for a certain number of years, or they've increased their dividends for a certain number of years. Because like we said in the past, that does show with your dividend kings and your dividend aristocrats, that does show resiliency. They pay those dividends over a long period of time. They're not going to cut them, or in theory, they won't cut them. And then maybe you want you want companies that have a certain percent dividend increase. That's basically like getting called into your boss's office and they're like, hey, Troy, you're going to get a 5% raise this year. That's money that you're working for, and you really hope you deserve that money. For dividend increases, you're just like, hey, all of a sudden, Apple is going to give you a 10% raise and you didn't do anything for it. Sounds good to me. You didn't have to go into the office. You didn't have to get sweaty palms. You just, went into your regular day and then got an email saying Apple increased their dividend. Sounds good. So that's step one, make decisions, time frame, risk tolerance, and criteria. My step two is, where do I start? So what you want to do is you want to narrow down the search. I think there's over 4,000 stocks on the US stock market. Not all of them pay dividends. So we're already doing that. We're already narrowing it down from all the companies to companies that just pay dividends. Then the next thing a good list you can choose from is you want to go through, like, you have blue chip list, which are companies with national reputation for quality, reliability, and the ability to generate profits in both good and bad times. That's important. So you can go with blue chips. If you want a little bit more consistency over long durations, you could go with the dividends aristocrats, 25 years of consecutive increases. We talked about that in the last video. Or the dividend kings. That's 50 years or more of consecutive dividend increases. So that means you are almost, you're almost sure that by investing in just the dividend kings, that you're going to get a dividend raise year over year, because it's kind of what the companies that you're investing do. So that's what you can do. A quick Google search for 2022 Dividend Kings. You should find a couple websites that'll give you those lists, and you can at least narrow down your search there. Like I said in the last video, there are 39 kings. So you see how quickly we went from 4,000 stocks to just dividend companies to just dividend kings. And you have 40 stocks pretty much that you're going to be really focusing on. And then you can apply that criteria that you did in step one, with your time frame, risk tolerance, and the criteria that you did pick, to that dividend king list or dividend aristocrats or the blue chips or all three. That's what I did. And then, there you go. So that is actually step three. Step three is to apply the criteria that you picked. So you narrowed down your list, you apply your criteria, makes it start to clear up your picture for you, makes it nice and easy. So step four is to do your research on the stocks that qualify based on your criteria. So you're going to get them there, and then you're going to narrow down the list, you're going to apply your criteria, and then you're going to start doing your research. Start looking at, like, are they making more and more money year over year? What's their payout ratio? Is it likely that the dividend gets cut? Stuff like that. There's plenty of articles that you can read on, maybe the analysts are saying this is a sell or a hold or a buy, and you can really dig into, like, why they're saying what they're saying. At the end of the day, it's a stock market. Nobody really knows. But if you have, 40 analysts and all of them are saying buy, probably a good idea. Not necessarily to just jump what they are, but maybe dive into that one and understand why it's important. So, and the last thing, most importantly, not most important, they're all really important, but very important step 5 is to pull the trigger. You have to get started. Whether you want to get started with a base of, like, hey, I want 50% of my portfolio to be VOO, which is the S&P 500, the total index, a basket of 505 stocks, 50% into that, and then maybe you want 50% to buy little individual stocks here and there. That's a good start, and you just have to pull the trigger and do it. I know investing your own money can be scary. But you have to get started like Becky did. She was like 21 years old. She started putting money in, and you saw the difference, $90,000 by the time they were retired. And that's without Becky investing in high quality dividend stocks. And that's without Becky contributing more money once she was 31 years old. Well, that's going to wrap it up for today's short video. Please subscribe to the channel if you're new here. Drop a like on the video to help me with the algorithm. comment down below if there's any questions you have on the content covered today, or if you have suggestions for future videos. Share with friends and family that may find it useful, and until next time, see you.